Hi, welcome back. In this session, we're going to start to talk about market efficiency, why it matters, and how it might drive your search for or lack of a search for an investment philosophy. The question of whether markets are efficient is central to investing, and here's why. If markets are in fact efficient, the market price is the best estimate of value, and if that is the case, the way you and I invest will forever be driven by that end game. If markets are not efficient, the market price can deviate from value, in which case the question you're asking is, can I find a way to exploit it? And every investment philosophy is built on the presumption that you can do that. Market inefficiencies are the basis for finding cheap or expensive stocks. And if you believe markets are inefficient, then you can find that subset of stocks where you can spend your time looking for bargains or looking for overvalued companies. In effect, what you're trying to do in your study of market efficiency is not answer an abstract question, but improve your odds as an investor because you believe markets are inefficient and you can take advantage of that inefficiency. With all of that said, though, it is very difficult to answer a question which I think is a basic question that every investor asks. What is an efficient market? What does it mean when we say a market is efficient? It doesn't mean that the price is always equal to the value. That's a presumption that people have. That's not true. In fact, in an efficient market, prices will deviate from value pretty much for every stock. The only basic presumption that creates efficiency is those deviations are random. In other words, you know the price is wrong, but you don't know in which direction. So there's an equal chance in an efficient market that a stock is under or overvalued, and you have no way of breaking that equality. If those deviations are not random, though, we open the door. If market mistakes are systematic and you can use something to find them, then every investment philosophy becomes a search for that factor that will allow you to find what's undervalued and what's overvalued. So with that lead in, let's talk about the different definitions of market efficiency. First, if you ask me, are markets efficient? I can't answer the question. That's too broad a question. And here's why. Markets are all over. There are markets and stocks, and even within markets and stocks, different geographies, different exchanges. It is entirely possible that some markets are efficient, some are not. In fact, I can say conclusively that making the statement that all markets are efficient is too strong, that statement is false, that some markets are likely to be inefficient, and others can be efficient. You can even have markets be efficient for some investors and not for others. Why? Because you have differences in taxes and transactions costs that can cause those variations. Or a market can be efficient to some investors some of the time and not efficient to others. Pockets of inefficiency can open up across markets and across time. And almost every definition of market efficiency has to be tied to what information is embedded in stock prices. In fact, more than 50 years ago, Gene Farmer won a Nobel Prize for drawing a distinction, not only defining efficient markets, but drawing a distinction with three definitions of market efficiency. In weak form efficiency, basically market prices reflect all of the information in past prices. What does that mean? You can't use past prices in charts and trends to detect what's coming next. That's weak form efficiency. In semi-strong form efficiency, market prices reflect not just the information in past prices, but in public information, financial statements, historical data on the companies, income statements, and balance sheets. Public information is reflected. In strong form efficiency, you go even further. The current price reflects not just what's in the public domain, but what individual investors have as private information. You say, how the heck will that show up in prices? Because they trade on that information. Weak form, semi-strong, strong form efficiency. But the implications of market efficiency are significant for any serious investor. Because if markets are truly efficient, then so much of what we do in investing, equity research and valuation, is pointless. It's a costly task that provides no net benefits because in an efficient market, you're never going to systematically find value for your money. In fact, in an efficient market, the best strategy for you is to pick an index fund, diversify across stocks, go back to living the rest of your life. And before you dismiss it, hold on, because later in this class, we're going to talk about that strategy relative to active investing. In fact, in an efficient market, even if you start to try to trade, that trading costs you. So strategy of minimizing trading is going to generate higher returns. The more active you are, the lower your returns are going to be in an efficient market. So it does matter whether markets are efficient. What it does not imply are the following, and I've heard people use this as the definition of market efficiency. There are people who argue that if stock prices deviate from true value, that must mean markets are inefficient. Not true. As I pointed out earlier, the mistakes just have to be random. I've heard people say in an efficient market, no investor will beat the market in any time period. That's absolutely not true. In fact, in any time period, roughly half of all investors, at least before transactions costs, should beat the market. But and in fact, even a group of investors can beat the market in the long term, because if you start with enough investors, the laws of probability alone will account for a few investors managing to succeed multiple years at a time. You can already see why proving that markets are inefficient becomes so difficult to do. But in an efficient market, if you truly live in one, the expected return on investment will be a function of what risk you take on and nothing else. The amount of activity, the amount of research you do will have little correlation with your actual returns. So what is it that makes markets efficient? Because they don't magically become efficient. What is it that makes markets efficient? For a market to be efficient, people have to think it's inefficient. I know that sounds, it sounds contradictory, but it is in fact true. Because here's how markets become efficient. Every time there's an inefficiency in the market, somebody's got to be able to find a way to use that inefficiency to make money. So they trade on that inefficiency. And there are other investors who watch them do this and imitate them. So for markets to become efficient, there need to be greedy, in the best sense of the word, profit maximizing investors who look for market mistakes, try to take advantage of them. 95% of them might fail, but in the process of taking advantage of market mistakes, they drive the market out. So, in fact, one of the great contradictions of market efficiency is if everybody thought markets are efficient, they would not be efficient. So here's some general propositions about market efficiency. The first is, you're more likely to find inefficiencies in markets where it's difficult to trade. You're more likely to find inefficiencies in the real estate market than you are in large publicly traded stocks. You're more likely to find inefficiencies in markets where there are high transactions costs and it's difficult to get information. Maybe some emerging markets as opposed to developed markets. You're more likely to find inefficiencies if information is difficult to get to, if it's opaque. And finally, you're more likely to find inefficiencies if the way you exploit it cannot be replicated by other investors. You can't watch what people are doing and follow them. Already you can see why some markets will be more efficient than others. It's going to be a function of the ease of trading, transactions costs, how easily you can get information, how easily you can watch other people trade and back out from their trading what they're trying to do. As I mentioned, the earlier contradiction, it became the basis for one of finance's most famous papers, so more than 40 years old, which talked about how if everybody believed markets are efficient, you could not have an efficient market. And here's why. If everybody believes markets are efficient, they'll stop looking for inefficiencies. And if nobody is looking for inefficiencies, if inefficiencies pop up, they will stay as inefficiencies. So to me, an efficient market is a process, a self-correcting mechanism. Markets are efficient, but then they become inefficient, they get efficient again. So basically, inefficiencies show up, but you need people constantly looking for those inefficiencies. Now, of course, one of the things that behavioral finance has done is held a mirror up to traditional finance. Traditional finance was built on the presumption that investors were rational. And in a world full of rational investors, efficiency is going to become the end game because the rational investors take advantage of market mistakes and the process drive them out. Behavioral finance laid out a whole set of challenges to rationality, things that people do that are not consistent with rational investors. And they argued that those irrationalities can explain why you see stock price bubbles, why you see momentum, things that go against the grain of an efficient market. In fact, you could argue that active investing is about exploiting those behavioral quirks that lead collections of human beings to do things that don't make sense. So you could argue that behavioral finance has laid the foundations for active investing, though active investing predates behavioral finance, lays the foundation for why active investing might provide a payoff. And if you look at the psychological studies underlying behavioral finance, and the reason I'm going to emphasize them is every investment philosophy, as I pointed out very early in this class, is built on a presumption of investors behaving badly, irrational investing. Here are some of the things that might cause investors to do things that you might be able to exploit with your active investing philosophy. The first is human nature to look at information relative to anchors that they have. So for instance, anchors are based on what you've seen historically. So if you historically have been used to PE ratios of 15 and stocks are trading at 20 times earnings, your anchor tells you stocks are overpriced. Psychological studies also show that stories can sometimes run ahead of the numbers. That the power of the story says that people fall in love with the story to stop asking questions. Often bubbles are based on big stories where people stop asking questions. It is also very clear from psychological studies of investors that we tend to be overconfident and that we tend to use hindsight bias to sometimes do things that don't make sense. A lot of herd behavior in investing. People buy because everybody else is buying. People sell because everybody else is selling. And the final factor that I think drives a lot of investing inefficiency is an unwillingness to admit mistakes. People hold on to losers far too long. Why? Because a very active selling is an admission to the world that you screwed up. Now, the reason I emphasize these psychological, and I've just put a subset of the psychological things that can cause investors to deviate from efficiency, is you are trying to take advantage of this behavior. And in doing that, though, you've got to recognize that this behavior is not going to disappear overnight. That when you go against the crowd, you're not rewarded immediately for going against the crowd. The crowd can keep going for much longer. Leading to the widely cited, Keynesian maxim, markets can stay irrational longer than you can stay solvent. So just because you can observe something happening in the market and attribute it to a behavioral quirk doesn't mean you can make money on it. Ultimately, though, when you look at the empirical evidence, you see it in the numbers. You see a lot of loss aversion. We talked earlier about, about risk and how we deal with it. A lot of investors, when you give them a choice of profits and losses, the way they deal with losses cuts against the grain of what you'd expect them to see. There's what's called the house money effect. The way people invest with money that they think is house money, somebody else's money, is very different than their own, which can explain professional money managers, can also explain what people do when they invest winnings from other stocks. And there's a break-even effect, which is when you lose money, you try to make it back, and sometimes you try to make it back in ways that make no sense. When you observe this in gamblers in general, where having lost money, you throw money at longer and longer odds, hoping to get back to break-even, and investors have the same phenomenon. Ultimately, though, this session is not talking about the specifics of market efficiency, but talk about why market efficiency is such a big part of investing, why we care, and the behavioral forces that can cause markets to be inefficient, because you need markets to be inefficient as an active investor to be able to beat the market, to take advantage of inefficiencies. But as you can see, taking advantage of behavioral inefficiencies is a lot easier, again, in the abstract than it is in practice. So in summary then, the question of whether markets are efficient or not is central to investing. And too many active investors are too quick to decide that markets are inefficient, often based on observations that I don't think quite make their case. I've heard people say that markets are inefficient because they move a lot. That proves absolutely nothing. The fact that markets are volatile can mean that the underlying value is volatile, or that there's trading happening that's causing price prices to be volatile. But unless you can make money on that volatility, it doesn't prove that markets are inefficient. I've heard some people argue that markets are inefficient because they know other people, and usually they name names, that have beaten the market over long periods. As I argued earlier, that's not entirely inconsistent with an efficient market where there are tens of thousands, even millions of investors trying to beat the market. I think later in this class, when we talk about index funds, we're going to set up the case for why it's so difficult to make the case that markets are inefficient in a way that you can take advantage of that inefficiency to make money. In other words, we might be able to prove that markets are inefficient in the sense that prices don't always equate to value, but it's much more difficult to argue that markets are inefficient in a way that you can make money off that inefficiency. I hope you found this session useful, and I thank you very much for listening.